So guys, in this video, I'm going to be answering some of the really great questions that I've been getting from all of you lately, starting with this one here from my friend Twig, who wants to know, what are your favorite recession-proof / defensive dividend stocks? This is a really great question and definitely a very timely one considering what's been happening in the market lately. So when it comes to recession-proof dividend stocks, generally speaking, you want to look for companies whose sales are less likely to be impacted by economic downturns. In other words, what products or services will people continue to use no matter what craziness is going on in the economy or across the world? And I'm sure we could come up with a long list of companies that fit that description, but a few that immediately come to mind for me are first and foremost Procter & Gamble. And this one is probably the most obvious because no matter what's happening in the economy, people still need toothpaste, toilet paper, diapers, soap, razors, dish soap, and all the other household essentials this company makes. And because of that, Procter & Gamble should be more insulated from any economic turbulence. So that's why I think it's a really good and also a really obvious recession-proof dividend stock to consider. With that said though, if you're not a fan of Procter & Gamble, as a substitute, you could also look to other companies like Clorox, for example. You could look at Kimberly-Clark or even Colgate-Palmolive. They're all pretty much in the same boat. Anyway, moving on, you can't talk about recession-proof dividend stocks without bringing up Johnson & Johnson. No matter what, people still get sick and people still get hurt, and Johnson & Johnson is very well diversified across pharmaceuticals and medical devices, so their sales come from two areas of the healthcare sector that are always in demand. Plus, this company's balance sheet is rock solid. The net debt to free cash flow ratio is only 0.6, which means they generate more free cash flow per year than they have in net debt. So you don't have to worry about Johnson & Johnson going bankrupt anytime soon. Now guys, this third stock might not seem like an obvious recession-resistant pick at first glance, but let me tell you, it definitely is. I'm talking about VICI Properties, and believe it or not, VICI has proven to be incredibly resilient during economic downturns. During the pandemic years, they collected 100% of rent from their tenants and maintained a 100% occupancy rate. A perfect score, guys, and better than most other REITs out there. With that said, I get that VICI Properties might not be for everyone, so if you're looking for some other solid REIT options, Realty Income is another very strong pick, and Agree Realty is as well. I don't think you can go wrong with either of these companies. Anyway, those would be a few of my favorite recession-resistant stocks, and now I want to hear from you. What are some of your favorites? Let me know in the comments below. Anyway, guys, moving on to question number 2. This one comes from my friend Christian, who asks, when you retire, would you cash out everything, put it all into SCHD, and just live your dream life, never checking the stock market again? And man, this is another really great question, and it's definitely something I do think about from time to time. I think there's absolutely an appeal to going all in on ETFs in retirement, just setting it and forgetting it, living my life without having to keep close tabs on my investments. I definitely could see the simplicity of that being a nice change of pace at some point. Right now, though, I really enjoy what I'm doing. I love learning about different businesses. I really enjoy investing in individual companies and having more of an active role in managing my portfolio. And so far, it's worked out pretty well for me. Since I started investing in 2020, my actively managed dividend portfolio has outperformed the S&P 500 by a few percentage points on average each year. And that could obviously change down the road, but as long as I enjoy the process and as long as it continues to work for me, I'll keep doing it. With that said, though, my general rule of thumb with investing is never say never. For example, I don't have an interest in trading options, but that doesn't mean I never will. And at this point in time, I don't own any non-dividend paying stocks, but that also doesn't mean that I never will. I don't want to be too dogmatic about anything because so much can change over time. And when it comes to going all in on ETFs, just because I don't have an interest in doing that right now, or just because I can't see myself doing that right now, doesn't mean that that won't change down the road. We'll just have to see what happens. For now, I'm just, taking things as they come and trying to enjoy the journey along the way, and I very much am. But I'll tell you what, if someday I do decide to go all in on SCHD, there are definitely worse ways to create passive income. With that said, as much as I do love SCHD, investing in dividend ETFs or investing in dividend stocks isn't the only way to create hands-off passive income. What if, instead of just owning slivers of all these different companies, you could own an entire business that pays you passive income without having to worry about any of the day-to-day operations? Well, that's exactly where the sponsor of today's video, Limits Express Company, comes in, and I want to tell you a little bit more about them. So Limits Express is a company that fully manages Amazon stores for their clients using Amazon's fulfillment service, known as Amazon FBA or Fulfillment by Amazon. Essentially how it works is sellers send their products to Amazon's warehouse warehouses, and Amazon takes care of the rest. It's a completely hands-off way of running an e-commerce store, and Limits Express makes it even more hands-off by setting up and managing the whole thing for you. They run fully managed Amazon FBA stores selling everyday consumer staples like toothpaste, mouthwash, deodorant, razors, stuff like that. You know, products people buy no matter what. And the products they sell are made by some of the biggest brands in the world, household names like Procter & Gamble and Colgate-Palmolive, which are companies we talk about quite a bit here on the channel. Now, what I really appreciate about Limits Express is their transparency. In the same way that I document my dividend investing journey here on YouTube, they're documenting their entire business on their YouTube channel. They make educational videos about Amazon FBA and also put out regular updates showcasing their clients' results. Plus, as a client, you can even visit their warehouse, meet the team, and see exactly how your business is being run. They actually encourage their clients to come visit. So like I said, Limits Express does all the heavy lifting and handles all the details of managing your Amazon store. You just split the profits. They're fully transparent, performance-based, and they only make money when you do, so they are highly incentivized to drive returns for their clients. And when it comes to returns, they're legally required to report their returns to the FTC. And according to those disclosures, which you can find on their website, clients are seeing average returns on investment of about 14% every month, which is a huge number when you think about compounding over time. Now, if you're interested in learning more about generating passive income through Amazon FBA, just click the link in the description of the video or in the pinned comment, or just scan this QR code right here to book a free 30-minute Zoom call directly with Kyle, one of the company's co-founders. If you're thinking about getting into Amazon FBA, I truly believe the best way to do it is just by outsourcing it to the pros who live and breathe this stuff every day. So definitely set up a call and start generating some more passive income with Limits Express Company. Anyway, guys, getting back to it and moving on to our third question of the day. This one comes from my friend Konstantinos, and Konstantinos says, I invested $8,000 into Vanguard's S&P 500 ETF a month ago near its peak, and now after the recent drop, I'm not sure what to do. Should I sell and take the 5% loss, then reinvest at a potentially lower point, or should I hold and buy even more if the market dips further? And this is another really, really great question. So when it comes to long-term investing, the best approach is usually the most simple and straightforward one. In this case, just keep buying and just keep holding. Timing the market by selling now and trying to buy back in at a lower share price is incredibly difficult. And there are many ways that that could backfire because nobody knows what the market is going to do moving forward. It's a mystery every single day. Plus, the whole point of investing in an S&P 500 ETF like VOO is that you don't have to worry about timing things perfectly. That's why it exists. It's designed to be a hands-off, automated way to build wealth over time. All you have to do is keep feeding it, and the rest will take care of itself. And when you get to the root of it, this is the essence of dollar cost averaging. By consistently investing over time, no matter what the market is doing, whether it's up or it's down, you automatically smooth out the ups and downs that occur along the way. And by doing so, you remove the stress of trying to time the market. With that said, it's important to remember that the market will naturally have its ebbs and flows, but historically it has always moved higher over time. Those who kept buying during downturns, whether it's 2008, 2020, or any other correction, were eventually rewarded for their patience. And another thing to keep in mind is that when share prices go down, you're able to buy more shares at a lower share price. You're able to make your investment dollars stretch farther, which in the long term is only going to help you in the pursuit of building wealth. And while it might be tempting to sell now and buy back in at a lower price, like I said, nobody knows what's going to happen in the market from here. Nobody can predict the future. We don't know if lower share prices will even come. So instead of trying to time things perfectly and be perfect, instead just focus on being consistent, because that's really the only thing that you can control in all of this, is how consistently you're investing. At the end of the day, investing is about time in the market, not timing the market. Even if you happen to buy at what seems like a high price today, years from now, today's price likely won't matter much. This 5% drop that you're experiencing right now won't even be on your radar. What will matter at the end of the road is how many shares you've picked up along the way and how long you've let them grow. So in short, my friend, just hang in there, keep buying, and try not to overthink it. You're already on the right track and you'll be just fine in the long run. Anyway, guys, now moving on to our fourth question of the day. This one comes from Kevin, who asks, Ryan, are you planning to hold VICI properties long-term, like 20 to 30 years? And yeah, I mean, I definitely would like to do so. Ideally, I would hold on to VICI properties for the rest of my life, but it really just depends on how things play out for the company over time. I think there's a lot to like about VICI, perfect occupancy rates, very long lease terms across their portfolio, and obviously they own some of the world's most irreplaceable real estate assets. And as someone who lives in Las Vegas, I can tell you I am very bullish on this city from a long-term perspective. To me, it just seems to be getting better and better over time. That's pretty much all I see here. So I'm very happy to have VICI in my portfolio, and it's definitely a company I have some personal attachment to, for better, for worse. It's like owning a piece of home. With that said though, if the company did at some point start to go downhill in a pretty serious way, I would certainly have to rethink my position. And when it comes to any of the stocks in your portfolio, I think that's how you should approach it. As a long-term dividend investor, you should go into your investments with the mindset that you'll hold on to them forever. I think that should be the plan going into them. But at the same time, you shouldn't be super rigid about that, because forever is a very long time. So much can happen between now and then, and things don't always go the way you plan. If a business is heading in the wrong direction, it's important to be able to recognize those warning signs and act accordingly. And in this next video right over here, I'm telling you about 3 companies that, in my opinion, are flashing some pretty big red flags. I wouldn't be surprised if dividend cuts were on the horizon for these 3 stocks, and I'm pretty concerned about them. So click right over here to find out which ones they are, and I'll see you in the next one.